Welcome back to our series on goods and service tax. Today we are continuing our discussion of input tax credit. In our previous session, we covered the basics of ITC. Today we'll explore some more complex but equally important aspects. We'll be covering several crucial topics today. How to apportion your input tax credit when you have mixed supplies, understanding blocked credits and what you cannot claim, special circumstances where ITC rules change, the procedures for reversing ITC, and finally, how to transfer ITC when your business structure changes. These concepts are fundamental for any GST practitioner. So let's dive right in. Let me start with a fundamental principle that governs input tax credit in GST. The rule is quite straightforward. ITC is available only when your output supply is taxable. Now, what does this mean in practical terms? If you are making exempt supplies, supplies that are not subject to GST, you cannot claim input tax credit on the inputs used for those exempt supplies. However, there's an important exception here. For zero-rated supplies, which primarily include exports and supplies to special economic zones, you can claim ITC even though the output tax rate is zero. This principle forms the foundation of how we determine what portion of your input tax credit you can legitimately claim. It's not always black and white, especially when businesses have mixed supplies, some taxable, some exempt. Let me walk you through the decision-making process for ITC apportionment. When you purchase goods or services, you need to ask yourself two key questions. First, are these goods and services used for business purposes? If the answer is no, say you're using them for personal consumption, then no ITC is allowed at all. This is straightforward. But if yes, they are for business, then comes the second question. Are they used for taxable supplies? If your entire business involves only taxable supplies, then you can claim the full ITC. Simple enough. However, the complexity arises when your business has mixed supplies, both taxable and exempt. In such cases, you need to apportion the ITC. You can claim ITC only on the portion that's attributable to taxable supplies, including zero-rated supplies like exports. The portion attributable to exempt supplies must be reversed or not claimed. This apportionment requires careful calculation and documentation, which we'll discuss in detail in our advanced sessions. Now let's move to a very important concept: blocked credits. Even if you're using goods and services in the course of furtherance of your business, the GST law specifically blocks ITC on certain items. Section 17(5) of the CGST Act provides a comprehensive list of goods and services for which input tax credit is not allowed, regardless of their business use. The philosophy behind these blocked credits is interesting. They primarily relate to items of personal consumption, immovable property, or specific scenarios that the government doesn't want to incentivize through tax credits. Understanding blocked credits is crucial because many businesses inadvertently claim ITC on these items, leading to complications during audits and assessments. Let's start with one of the most encountered blocked credits: motor vehicles. The general rule is that ITC is not allowed on motor vehicles used for transportation of persons with seating capacity of 13 or fewer persons, including the driver. So if you buy a car, SUV, or small van for your business, you generally cannot claim ITC on it. But wait, there are exceptions. You can claim ITC if these vehicles are used for specific eligible purposes. If you are in the business of selling such vehicles, if you are using them for passenger transportation as a business, or if you are running a driving school. Now, let me clarify what's not considered a motor vehicle under this restriction. Vehicles running on fixed rails like trains, special purpose vehicles used within factory premises, and vehicles with less than 4 wheels with engine capacity up to 25 cc are excluded from this restriction. Also remember, if you buy vehicles with seating capacity of more than 13 persons, like buses, you can claim full ITC regardless of their use. Similarly, goods carrying vehicles like trucks, dumpers, and tippers are eligible for ITC. The blocking extends beyond just motor vehicles to vessels and aircraft as well. However, similar to motor vehicles, there are exceptions. You can claim ITC on vessels and aircraft when they're used for eligible purposes like further taxable supply, transportation of passengers or goods, or for training purposes. Now, here's where it gets more complex. Services related to these blocked assets are also generally blocked. This includes general insurance, servicing, repair, and maintenance of ineligible motor vehicles, vessels, and aircraft. But again, there are exceptions. You can claim ITC on these services if they're used for eligible purposes, or if they're received by manufacturers of these assets, or by insurance companies providing coverage for these assets. The law also allows ITC when you're using these services for making outward taxable supplies of the same category when they're provided by employers under statutory obligations, or when you're in the same line of business, essentially subcontracting arrangements. Leasing, renting, or hiring of these ineligible assets is also blocked, with similar exceptions applying. Moving on to another category of blocked credits: food and beverages, outdoor catering, life insurance, health insurance, beauty treatments, health services, and cosmetic and plastic surgery. The rationale here is clear. These are typically personal consumption items or services that provide personal benefits rather than business benefits. However, the law recognizes that sometimes these items might be legitimately used for business purposes. So you can claim ITC on these blocked items in 3 specific situations. When you are in the business of providing the same category of goods or services. For example, a restaurant can claim ITC on food items it purchases when these are provided by an employer to employees under statutory obligations, or when you're subcontracting these services. Let's look at 2 more specific blocked credits. First, membership of clubs, health and fitness centers. The ITC on these is blocked because they are typically seen as providing personal benefits rather than business benefits. However, there's one exception. When these memberships are provided by an employer to employees under a statutory obligation, ITC can be claimed. The second item is travel benefits provided to employees for vacation purposes. This is clearly personal in nature, and there are no exceptions listed for this particular blocked credit. This is perhaps one of the most complex areas of blocked credits: construction of immovable property. There are 2 specific restrictions here. First, works contract services for construction of immovable property are blocked. Second, inward supplies used for construction of immovable property on your own account are also blocked. But before you think all construction related ITC is blocked, let me explain the exceptions. ITC on works contract services is available when they are availed by a works contractor for further supply, essentially subcontracting, when they are used for construction of eligible plant and machinery, or when the value isn't capitalized in your books. For goods and services used in construction, ITC is available when used for construction of eligible plant and machinery, when the value isn't capitalized, or when the construction is not on your own account. Now, what constitutes plant and machinery? It includes apparatus, equipment, and machinery fixed to earth by foundation or structural supports. However, it excludes land, buildings, telecommunication towers, and pipelines laid outside factory premises. It's also important to understand that construction includes reconstruction, renovation, additions, alterations, and repairs to the extent they're capitalized. If these activities aren't capitalized in your books, they don't constitute construction for GST purposes, and ITC is allowed. Another category of blocked credits relates to goods that are disposed of as gifts or free samples, or goods that are lost, stolen, destroyed, or written off. The logic for samples and free gifts is that when you give away goods without consideration, it doesn't qualify as a supply under GST unless it's covered under Schedule 1 of the CGST Act. Since there's no corresponding output tax liability, ITC is blocked. However, if the distribution qualifies as a supply under Schedule 1, which covers certain transactions deemed as supplies, even without consideration, then ITC is allowed. For lost, stolen, destroyed, or written off goods, the blocking is because there's no corresponding output supply to match against the input tax credit claimed. Let me explain a special situation that often confuses practitioners: the return of goods. The GST law has specific provisions for handling returns, and the treatment varies based on who's returning the goods. When registered persons, except composition taxpayers, return goods, they treat the return as a fresh supply and issue an invoice. The value shown should match the original invoice value. The recipient, typically the wholesaler or manufacturer, can avail ITC on this return supply, subject to meeting all conditions under Section 16. Composition taxpayers handle returns differently. They can return goods by issuing a bill of supply and paying tax at the applicable composition rate. However, the recipient cannot claim ITC in this case because composition taxpayers cannot issue tax invoices. Unregistered persons can return goods using any commercial document without charging tax, and no ITC is involved for the recipient. Now, here's an important point for manufacturers. If you receive time expired goods as a return and subsequently destroy them, you must reverse the ITC you claimed on the return supply. Note that this reversal applies only to the returned supply, not the original goods. Let me quickly cover some other blocked credits that you should be aware of. ITC is not allowed on inward supplies charged to tax under composition levy. This makes sense because composition taxpayers pay tax at reduced rates and cannot issue proper tax invoices. Non-resident taxable persons cannot claim ITC on inward supplies except for imports of goods. Services imported by NRTPs don't qualify for ITC. Obviously, inward supplies used for personal consumption don't qualify for ITC. Finally, tax paid in cases involving fraud, detention, or confiscation cannot be claimed as ITC. This provision ensures that the tax credit mechanism isn't misused in cases of non-compliance. Now let's move to a different topic: ITC in special circumstances. Section 18 of the CGST Act provides for ITC entitlement when there are changes in your registration status or tax liability status. There are four main scenarios where you can claim ITC on stocks held. First, when you apply for registration within 30 days of becoming liable and get registration, you can claim ITC on inputs held on the day before you became liable to pay tax. Second, when you take voluntary registration, you can claim ITC on inputs held on the day before registration was granted. Third, when you cease to pay tax under composition scheme and move to regular scheme, you can claim ITC on both inputs and capital goods held from the day you became liable to pay regular tax. Fourth, when your exempt supplies become taxable, you can claim ITC on inputs and capital goods from the day such supplies become taxable. Remember, inputs here includes inputs held in stock and those contained in semi-finished or finished goods. Also, you must avail this ITC within 1 year from the date of the supplier's tax invoice. Let me walk you through the process of availing this special credit. It's quite detailed, so pay attention. First, identify eligible inputs and capital goods held on the day immediately preceding your credit eligibility date. Second, make an electronic declaration in Form GST ITC 01 providing details of all eligible inputs and capital goods. This declaration must be filed within 30 days of becoming eligible for the credit. If your aggregate claim of CGST, SGST or IGST credit exceeds rupees 2 lakh, the declaration must be certified by a practicing chartered accountant or cost accountant. The ITC claimed will be verified against the corresponding details furnished by your suppliers in their GSTR1 or GSTR4 returns. For capital goods, the ITC must be reduced by 5% for each quarter that has elapsed from the date of the original invoice. This accounts for the depreciation in value over time. Now let's discuss when you need to reverse ITC. Just as there are provisions to claim ITC in special circumstances, there are also requirements to reverse ITC when you exit the normal tax regime. You must reverse ITC in three scenarios: when you opt for composition levy, when all your supplies become wholly exempt from tax, or upon cancellation of your registration. This reversal applies to both inputs and capital goods on which you had earlier claimed ITC. The logic is that if you're no longer making taxable supplies, you shouldn't retain the benefit of ITC claimed earlier. The reversal procedure involves several steps. First, you need to determine the reversal amount based on proportionate calculations for both inputs and capital goods. The reversal amount is added to your output tax liability for the period of switchover, exemption, or cancellation. You must furnish details of this ITC reversal by filing Form ITC 03 for events under Section 18.4 or Form GSTR 10 for registration cancellation. This reversal amount is then debited from your electronic credit ledger or electronic cash ledger. Any remaining balance in your electronic credit ledger after the reversal simply lapses. You lose it permanently. Calculating the reversal amount requires careful attention to detail. For inputs, you calculate ITC reversal proportionately based on invoices corresponding to inputs on which credit was availed. If invoices are unavailable, which can happen in cases of lost records, you calculate reversal based on the market price of goods on the date of switchover or exemption. This calculation must be certified by a practicing chartered accountant or cost accountant. For capital goods, the calculation is based on remaining useful life. The useful life is considered as 5 years for this purpose. You must calculate ITC reversal separately for CGST, SGST, UTGST, and IGST, maintaining the same tax-wise breakup as your original claims. There's a special provision for ITC reversal when you supply capital goods or plant and machinery on which you had claimed ITC. In such cases, you must pay the higher of two amounts. First option, ITC taken on such goods, reduced by 5% per quarter from the date of invoice issuance, calculated based on remaining useful life. Second option, tax on the transaction value of the capital goods or plant and machinery being supplied. You pay whichever is higher. This ensures that the government doesn't lose revenue either way. If the ITC calculated for remaining useful life exceeds the tax payable on transaction value, the excess amount must be added to your output tax liability. Let me explain the calculation method for capital goods supply in detail. The useful life of capital goods is considered as 5 years or 60 months. To calculate remaining life, subtract the number of months the capital goods was in use from 60 months. The reversal amount equals ITC taken multiplied by remaining useful life divided by 60. Remember to calculate separately for CGST, SGST, UTGST, and IGST. There is a special exception for refractory, bricks, molds, dies, jigs, and fixtures. If these are supplied as scrap rather than functional items, tax may be paid only on the transaction value of the scrap, which is typically much lower. Sometimes businesses undergo changes in their legal structure. Sales, mergers, demergers, amalgamations, lease, or transfer of ownership. The GST law provides for transfer of unutilized ITC in such cases. When there's a change in constitution with specific provisions for transfer of liabilities, the registered person can transfer unutilized ITC from their electronic credit ledger to the new entity. This includes scenarios like change in ownership due to death of a sole proprietor. In demerger cases, ITC is apportioned in the ratio of asset values transferred to new units as specified in the demerger scheme. It's important to note that value of assets refers to total value of all business assets, regardless of whether ITC was availed on them. The transfer procedure involves several steps and requires proper documentation. First, file form GST ITC 02 informing about the change in constitution and requesting transfer of unutilized ITC to the transferee. You must submit a certificate from a practicing CA or cost accountant certifying that the change in constitution includes specific provision for transfer of liabilities. The transferee must accept these details on the common portal. Upon acceptance, the unutilized ITC gets credited to the transferee's electronic credit ledger. Finally, the transferee must properly record the transferred inputs and capital goods in their books of account. The final topic today is transfer of ITC when you obtain separate registrations. Under Section 25, you can obtain separate registrations for multiple places of business within the same state or union territory. When you obtain such separate registrations, you can transfer unutilized ITC wholly or partially from your existing registration to the new registrations. The transfer must be in the ratio of asset values held by each place of business at the time of registration. You must furnish details in Form GST ITC 02A within 30 days of obtaining separate registrations. The transferee locations must accept these details on the common portal, after which the ITC gets credited to their electronic credit ledgers. That brings us to the end of the session on GST input tax credit. Let me quickly summarize what we've covered today. We started with the fundamental principle of ITC apportionment and the decision-making flowchart for mixed supplies. We then explored blocked credits in detail, covering ineligible motor vehicles, vessels and aircraft, food and beverages, personal services, membership benefits, construction of immovable property, and various other restrictions. We discussed special circumstances where ITC can be claimed on existing stocks, including the detailed process and documentation requirements. We covered ITC reversal scenarios, procedures, and calculations, including the special provisions for capital goods supply. Finally, we looked at ITC transfer provisions for changes in business constitution and separate registrations. These concepts form the backbone of practical ITC management in GST. In our next session, we'll continue building on these foundations with more advanced ITC topics. Thank you for your attention, and I'll see you in the next lecture.